On March 19th, the FDIC quietly reversed a rule that had blocked private equity from buying failed banks. No press conference, no prime time coverage. There's something that the FDIC isn't saying out loud. Watch this to find out what it is and what to do.
You already sense it. Something is wrong with the banking system. You watch institutions collapse and hear that everything is fine. That instinct is not paranoia. It is pattern recognition. And this video is going to show you exactly why. In March 2026, the FDIC quietly reversed a rule put in place after the 2008 crisis. No press conference, no primetime segment, a policy reversal buried inside a regulatory update. The rule they removed stopped private equity firms from buying your bank when it fails. That barrier is now gone. The FDIC explained why. Banks can now fail faster than they could in 2008. Given the increased speed of failure, they need more buyers ready, not fewer, more. Silicon Valley Bank collapsed in 48 hours. A bank run that used to take weeks now happens from a phone screen in an afternoon. The new reality is a weekend. The first bank of 2026 already failed. Metropolitan Capital, Chicago, January 30th, a $19 million cost to the insurance fund. This is about what the FDIC understands about the direction of what is coming and what you need to know about your deposits. When your bank fails, the FDIC does not call you. There is no vote, no warning email. By Monday morning, there is a new owner. This happened to 37 million depositors across 465 bank failures between 2008 and 2012. Most believed their money was safe. When a bank fails, the FDIC takes control, typically on a Friday. Your accounts move automatically to the acquiring institution. You had no say in who the acquirer is. The decision was made over a weekend by regulators whose job is to protect the fund. If your deposits are within the limit, you are protected. If they exceed it, you become an unsecured creditor. Recovery takes years. The limit is $250,000 per depositor, per institution, per category. The category distinction is where the exposure hides. A personal checking account and a joint account are separate categories. Most people have never calculated their actual coverage. The bank will not explain this proactively. The gap between what the system assumes you know and what you verified is the danger. July 11th, 2008, IndyMac Bank fails. The largest thrift failure in American history at that point. Friday afternoon, regulators walk in. Monday morning, depositors are standing in lines outside branches. For those above the limit, years of waiting began. 8 months later, the FDIC sells IndyMac to a private equity group for $1.5 billion. The FDIC had spent $10 billion resolving it. The gap between the resolution cost and the acquisition price is the mechanism. The crisis created the discount. The group renames it OneWest. They sell it 7 years later for over $3 billion. The depositor who lost money did not participate. One of the co-founders, Steven Mnuchin, later became Treasury Secretary. This is a fact about how these cycles work. September 25, 2008, Washington Mutual, the largest bank failure in American history. JP Morgan acquires it for $1.8 billion. Shareholders and bondholders were wiped out. No appeal. Done by Monday morning. The crisis price acquisition was complete. The rule the FDIC removed in March 2026 was put in place to limit private equity's access to these failed institutions. Now it is gone. The FDIC board called the protection onerous and prescriptive. They did not remove it because the environment is calm.
Hey, real quick, I just wanted to cut in and say, when the rules start changing around failed banks, some people start asking different questions. How much of their money depends on trusting the system to work the way it does? The Bitcoin and security bundle that I put together of courses was built for that moment. It helps you understand Bitcoin, avoid beginner mistakes, and think through security before you put real money at risk. I'm going to drop the link down below if you want to learn more about it. All right, now let's get back to the video.
The deposit insurance fund came under pressure after bank failures in 2023. A large wave of failures would test its capacity. The FDIC's problem bank list has been rising. 52 institutions with assets of $66 billion were on it before 2026 began. These are not healthy conditions being managed. These are stress signals being monitored. Commercial real estate is the center. Offices once 95% occupied are now at 50%. The math on those loans does not work at current valuations. The limit has been reached. When a private equity firm buys a bank, it acquires the depositors, your account, your direct deposit, your payroll, all of it. The new owner must protect deposits, but they also have an obligation to their investors to generate a high return. Those obligations do not always align. PE ownership produces different incentive structures than bank ownership of a bank. After the IndyMac acquisition, OneWest initiated over 36,000 foreclosures while maximizing government loss share payments. This is not a moral judgment. It is a structural observation about what different types of owners optimize for. The rule changed on March 19, 2026. It was a policy reversal in a regulatory update. Not on the front page, not on news. Regulators do not expand acquisition infrastructure for quiet periods. They build it for the periods they are anticipating. What they are anticipating, they have stated through their actions, not through their press releases. The speed of bank runs is now ours. The new reality requires a larger, faster, more liquid buyer pool. The rule change is a direct response to that reality. Here is what the system does not tell you. The guarantee on your deposits is real, but it is specific. It has limits. The fund behind the guarantee is not unlimited. When the mechanism activates, it moves faster than your ability to react. Understanding where your deposits sit relative to the limits is the only preparation the system allows you. Control what you can. Once the regulator walks in on a Friday afternoon, decisions are made by people whose job is to protect the insurance fund, not you. Map your accounts, know your categories, know your actual covered exposure at every institution where you hold deposits. That knowledge costs nothing. It requires 1 hour. Most people find out what they should have known on a Monday morning news segment. The FDIC changed the protection rule because the environment requires flexibility. The problem bank list is rising. Stress is real. They have stated that banks can fail faster than ever before. They need more options when it happens. You now have the information. The part of this you control is what you do with it. Knowledge is clarity, not panic. Stay equipped.